It is usually easier to trade during a trend, because as we learn, a trend can be strong and its natural tendency is to proceed. If you go with it, then most chances are that it will not suddenly reverse and change its direction all the way back. You just need to basically find the right entry points, make sure you don't risk too much, and let the profits run. The thing is that most of the time the market is not being traded in strong trends, so you have to know how to trade in different situations. In a ranging market, you have less room for price movements as the prices are usually limited to a certain area on the upside and another area on the downside. The distance between them doesn't leave you much space to trade. But on the other hand, there is a great advantage for that, because as we said, during a trading range, most upside and downside movements stop at around the same levels again and again. These levels can be identified and marked as supports and resistances. They are one of the most useful tools to use in this type of market. They help us to determine where the prices are expected to stop and use it for our advantage by buying and selling accordingly. Supports and resistances are super important concepts when it comes to chart technical analysis. Support is a level where there is a sufficient buying power in order to stop a current down movement. And resistance is a level where sellers are strong enough to stop price increases. When prices reach those levels, they might halt temporarily, and sometimes if the levels are strong enough, they can completely change the overall direction and cause a reversal pattern. It's easy to understand it when you think of a ball that bounces from the floor to the ceiling and back. The floor is the support, and once the ball hits it, it rises toward the ceiling, which is the resistance that pushes it back down. If one of those levels is not strong enough, then the ball would break it and continue further towards higher or lower levels. Strong support and resistance levels are powerful, and the element that makes them so effective is an important principle we use a lot in technical analysis, and this is the self-fulfilling prophecy. People remember that previously prices stopped on certain levels, so they assume the same is likely to happen again. They decide to buy and sell at the same levels, then other people that analyze the market see that there were many buyers or sellers at a specific level, so they prefer to join them and therefore strengthen those levels even more. The truth is that when you apply technical analysis, you don't care about reasons. As a trader, you care about the bottom line, and the bottom line is that supports and resistances tend to work. But it's also important to understand what causes certain behaviors. And now you know that when many other traders are looking at the same charts, they are likely to act in a similar way. This fact makes it easier to anticipate what will happen to the price when it reaches there. Another important thing to know is that the longer the congestion area between the upper and lower limits, the stronger the supports and resistances are. With time, more and more traders are committed to act in those areas, making them even more reliable indications. But eventually, at some point, they will be broken, and when that happens, they tend to change their roles. So what was support before will now become a resistance, and the other way around. The recent resistance would become the new support. When the market is not trending and traders recognize strong support or resistance point, they simply buy the support and sell the resistance, making profits from the difference. But first, you must know how to draw support and resistance line that will serve you best. So when you draw a line, you want one that was touched many times. Let's have a look at this 1 hour candlestick chart of the ETH USD. The line was first created here, when price played above and below this area. Then we can see it becomes a very significant region for prices. Look how many times buyers were attempting to push prices higher but failed. Then after 2 days of trying, bulls took control and managed to violate the resistance upward. We can see it with this strong candle and the one after it. They were traded with a large volume, fact that strengthened the assumption of a breakout. As I said before, once a resistance is broken, it becomes a support. And this is exactly what we see here. Look how many times the price went lower, trying to downbreak without any success. It was only here, with large bearish engulfing candle, followed by another large red candle with great volume, that the support was breached. So that was a good example for a resistance line, and for a short period of time, it also played the role of a support line. But we can't ignore another significant line that was created around the same time. It was first created here, where about 10 candles were playing above and below it. At this stage, we could imagine that the next time's price would reach this area, something will happen. And look at the chart. First we have this long lower shadow that couldn't reach it. Then another one. Here another 2 candles and a change in momentum. And look how many times seller was failing to overcome this support line. It was just about a week later that a string of decisive red candles were able to go below it and change the momentum. If you ask yourself what will happen next with these lines, you can expect from both of them to be quite strong resistances to a possible rally. It would take a lot of buying power in order to upbreak them. And eventually, when the price will be able to break them, you guessed right, they will become supports again. See how many profitable trades you could have made by just drawing 2 simple lines and then buying and selling according to it. That only shows you how powerful those levels can be if drawn properly during a trading market.